With the recent presidential election and sweeping changes across Congress, tariffs are now a major topic of discussion as the new administration looks to increase the size and scope of this policy tool. But what do tariffs really mean for you, your wallet, and the economy at large? Let's break down the potential impacts and what you should be prepared for. First, let's understand why tariffs can be controversial. Supporters of tariffs say they help protect American industries and jobs by combating unfair trade practices and encouraging new investment within the nation's borders. On the other hand, critics argue that Americans ultimately bear the cost, facing higher prices for goods that could be imported more cheaply and spurring retaliatory tariffs by other countries, hurting our exports. The truth is, there isn't a clear line, and there are many complicating factors in play. That's because every economic policy has trade-offs which must be considered. So what happens when tariffs are quickly imposed on a wide scale? An immediate impact is higher prices. The U.S. can't switch gears and start manufacturing imported goods overnight. It takes time and significant investment. In the short term, exporters may charge more to cover tariff costs on items we can't go without, like prescription drugs, medical equipment, electronic components, food, and energy. Until adjustments are made, plants are built, and new supply chains are established, exporters will likely pass on the cost of tariffs by increasing the price Americans pay for essential goods, while consumers may find themselves foregoing higher cost discretionary purchases, therefore accepting a lower standard of living. The hope is that in the long run, by penalizing investment outside the United States, tariffs will encourage increased investment inside the United States, increasing U.S. production by building more factories and plants, improving our technology and infrastructure, and creating the capacity to build many of the goods we currently import. So what does this mean for your personal finances? Those working in industries protected by tariffs could see increased wages and job opportunities. This may spill over to wages in other sectors as well, but this won't be immediate. It will take many years to build out the infrastructure and supply chains necessary. And even then, increased labor costs may mean higher prices, at least partially offsetting any wage gains. Industries that rely on exporting to other nations may be hurt, since other countries may respond by implementing tariffs of their own. For retirees and individuals on a fixed income, paying higher prices without the benefit of increased wages could pose financial challenges. Most retirees primarily rely on financial assets saved in retirement accounts such as IRAs and 401ks, and those assets could come under pressure in the future. The stock market and economy do not necessarily move in lockstep, and since the 2008 global financial crisis, stock prices have risen substantially faster than company earnings, at least partially because of government stimulus. Since 2008, the government and Federal Reserve have pumped trillions of dollars of stimulus into the economy during times of weakness. While these funds have kept businesses and banks afloat who may otherwise have gone under, it's only helped to prevent larger economic downturns, but has failed to stimulate new growth through real business investment. Instead, much of that money ended up in financial assets like stocks, bonds, and real estate, leading to some of the highest values we've seen since the dot-com bubble and Great Depression. So in a sense, weaknesses in the economy have been a driver behind the booming financial markets over the last 15 years, partially due to government stimulus response. If tariffs lead to new economic investment opportunities in the U.S., there could be a pivot as to where money flows. More money may flow into real economic capital, such as infrastructure and technology, leaving less money to fuel financial market prices. More borrowing may also take place to facilitate these investment opportunities, which would contribute to higher interest rates, affecting the cost of buying homes and automobiles. While this renewed investment would in time help strengthen the economy, it could ironically dampen stock, bond, and real estate returns compared to what we've grown accustomed to, bringing prices back down closer to historical levels when measured against a company's earnings. This could mean that retirement portfolios do not perform as well as in the past, negatively affecting the income of retirees who also face higher prices. The impact and timing of new tariffs is still uncertain. There are many decisions ahead for the new administration as to how and where these policies will be implemented. In times of uncertainty, many turn to physical gold and other precious metals. Historically, gold has been a safe haven asset, a reliable hedge against inflation and uncertainty. As tariffs reshape economic landscapes around the globe, consider protecting your financial future with gold.